Every nation on Earth carries debt. The United States now owes more than $38 trillion, the largest figure in its history. The European Union carries roughly 14 trillion. Japan approaches 9 trillion. Even resource-rich countries like Saudi Arabia and export powerhouses such as Germany and China all owe enormous sums. This raises a paradox that feels almost absurd. If everyone is in debt, who exactly is the creditor? This is the terrain of financial history, where money, power, and structure collide, and where nothing is ever as simple as it appears. Debt is not merely a burden. It is the architecture of the modern world. Every war, every crisis, every boom and bust rests on this invisible scaffolding of IOUs. And when you trace the chain of creditors far enough, something unsettling emerges. The world does not owe money to a single entity. It owes it to itself. That does not mean the benefits are shared equally. To understand how we reached a planet carrying more than $315 trillion in total debt, nearly 3 times the size of the global economy, we have to return to the origin of sovereign borrowing. Long before credit cards or digital transfers, national debt was born not in markets, but in war. In 1694, England was fighting France and running out of gold. The crown turned to merchants for financing. In exchange for a permanent stream of interest payments, backed by future taxes, private capital funded the state. To manage this arrangement, the Bank of England was created. This was revolutionary. For the first time, governments could spend money they did not yet have. In return, lenders received something unprecedented: a promise from the state. A promise that could be traded, sold, and inherited. The government bond was born, the seed of the modern financial system. France adopted the model. The Netherlands refined it. The newly independent United States used it to finance its revolution and expand westward. National debt ceased to signal weakness. It became a measure of credibility. The ability to borrow became the ability to rule. Empires once conquered territory to extract gold. Now they issued bonds to extract interest. The battlefield shifted from land to balance sheets. 3 centuries later, debt has become the world's dominant export. The United States owes $38 trillion. Japan over $9 trillion. Global borrowing increases by roughly $1 trillion every 100 days. Every country owes. Every bank lends. Every citizen, through taxes, pensions, and savings, is both debtor and creditor at the same time. So who holds the other end of the rope? Start with the United States, because its debt is not merely national, it is global. Of the total, roughly half is publicly held, meaning owed to investors rather than internal government accounts. About 2/3 of those investors are domestic: banks, pension funds, mutual funds, insurance companies, and the Federal Reserve itself. The remaining third, around $9 trillion, is held abroad. Japan is the largest foreign holder, followed by China, then countries such as the United Kingdom, Luxembourg, and Belgium. When people say the United States is indebted to China, they are not wrong, but it represents only a small fraction of the total. Most American debt is owed to Americans. The Treasury issues bonds. Financial institutions purchase them. The Federal Reserve often buys them back, creating new dollars in the process. Tax revenue funds interest payments, which then flow into retirement accounts and financial portfolios. It is a closed loop. The debt is real, but the creditor is largely a reflection of the same system. And this circularity is not uniquely American. It is global. Japan lends to the United States through treasuries. The United States lends to Europe through international institutions. Europe lends to developing nations via the World Bank. Developing nations lend back to advanced economies by holding foreign exchange reserves and Western government bonds. It is a planetary exchange of promises. Every country holds someone else's IOU. Every promise is secured by another promise. Picture a poker table where every player has borrowed chips from the next. The game continues only as long as no one stands up. Above this sits a fourth layer, the most powerful of all, the financial markets themselves. Behind every government bond is a dense web of institutions, hedge funds, pension funds, sovereign wealth funds, and central banks managing tens of trillions in assets. These entities are the real arbiters of credit. They decide who can borrow cheaply and who must pay a premium just to survive. When confidence evaporates, currencies collapse, governments fall, and entire economies can be restructured overnight. Democracy determines who governs. Markets determine who endures. At the center of this system sits the modern high priest, the central bank. Central banks do not simply manage debt. They create it. Each time a central bank purchases government bonds, it creates new money in exchange. One balance sheet's liability becomes another's asset. Every unit of currency in circulation represents a unit of debt somewhere else. There is no such thing as debt-free money. For decades, this system has sustained itself on confidence. As long as investors believe governments will continue paying interest, even if the principal is never repaid, the machine keeps running. But history shows what happens when confidence breaks. In Greece in 2010, government debt became unsustainable. Bondholders panicked. Yields exploded. International institutions intervened. The rescue came with austerity, tax increases, spending cuts, mass unemployment. For an entire generation, bailout became synonymous with sacrifice. Argentina's repeated defaults turned debt into a national trauma. Sri Lanka's foreign currency crisis led to fuel shortages and political collapse. When the system fails, creditors suddenly become visible. International institutions, rating agencies, anonymous bondholders holding entire nations hostage. Yet even after collapse, the same logic resumes. Old debts are restructured. New loans replace old ones. The machine restarts. Because in the modern world, debt is not designed to be repaid. It is designed to be rolled over. Governments do not plan to eliminate their debt. This is not conspiracy. It is policy. Unlike households, states refinance continuously, issuing new bonds to pay off old ones. Interest becomes the true product, the rent charged for stability. The global economy depends on that rent. The United States will never fully pay off its debt. Japan has rolled over its obligations for decades, now exceeding 250% of GDP, yet its borrowing costs remain near zero. Investors are not waiting for repayment. They are waiting for renewal. Government debt is treated as the safest asset in existence. Treasuries underpin pensions, secure banks, and anchor global markets. If governments paid off their debt entirely, the system would lose its most trusted collateral. Paying down the debt would destroy the mechanism that makes the economy function. So governments do the opposite. They issue more, not recklessly, but rhythmically. Debt becomes the heartbeat of capitalism itself, pulsing through every pension, mortgage, and market on Earth. This is why political promises to eliminate national debt are illusions. The goal is not repayment. It is sustainability, keeping debt serviceable, credible, and desirable enough that belief never collapses. Because once belief fades, numbers stop mattering. Interest rates spike. Markets freeze. An economy built on rolling promises grinds to a halt. That is the true secret of sovereign debt. The plan was never to pay it back. The plan is to keep the world believing it will be. But belief is not evenly distributed. When we say we owe the debt to ourselves, that is only partially true. Interest payments flow upward, from taxpayers and workers to the institutions that hold the debt. Debt is not just a transfer between nations. It is a transfer between classes. That is why global indebtedness and global inequality rise together. The system rewards those who own debt and burdens those who service it. At the top of this pyramid, there is no single villain. Not China, not Wall Street, not international institutions alone. It is a system that converts promises into money and belief into stability. Debt once meant bondage. Today it means balance. But balance depends on trust. And trust does not last forever. If this analysis changed how you see global finance, power, and debt, subscribe to Empire of Money, where we trace the hidden structures behind the world's most enduring economic systems.